Margin rules determine how much capital you need to hold options positions, and they can drastically change your strategy. The two main systems are Reg-T and portfolio margin. In this video, we'll unpack the differences, explain how they impact your trading, and show when portfolio margin can be a game changer, and when it can be a trap. The basics of Reg-T margin. Reg-T margin is the standard framework for most retail accounts in the US. It's rules-based, not risk-based. For short options, the broker holds margin equal to the maximum potential loss, or a fixed formula, whichever is higher. That often means big capital requirements, even if your overall portfolio is well hedged. Reg-T keeps things simple, but it can tie up cash unnecessarily. Portfolio margin explained. Portfolio margin, or PM, is more advanced. Instead of fixed rules, it uses risk models like the OCC's TIMS to simulate stress scenarios across your whole portfolio. Margin is based on net risk exposure, not just each trade in isolation. If your positions hedge each other, margin requirements can shrink dramatically. Example: a large iron condor might eat up huge margin under Reg-T, but with portfolio margin, the broker recognizes offsetting risk and requires much less capital. What changes for the trader? Here's how trading changes with portfolio margin. Leverage increases. You can trade more size with the same account equity. Strategy: flexibility. Complex spreads, hedges, and arbitrage plays become more capital efficient. Dynamic requirements. Margin shifts with market conditions and volatility. Spikes in VVIX can raise your margin overnight. Higher entry bar. Most brokers require $100K, $150K minimum equity plus experience approval. For the active options trader, PM feels like taking off the training wheels, but it also means you can wipe out faster if you over-leverage. Who benefits most? Portfolio margin isn't for everyone. It's most useful for professional-style traders running complex spreads or hedged books. Volatility traders who benefit from reduced margin on offsetting positions. High net worth investors who want capital efficiency on large portfolios. If you're trading naked options without discipline, PM just amplifies risk. Think of it as a sharper tool, great in skilled hands, dangerous otherwise. To recap, Reg-T is rules-based and conservative, keeping margin high and simple. Portfolio margin is risk-based, reducing requirements for well-hedged positions. For options traders, PM means more leverage, flexibility, and efficiency, but also more responsibility. If you earn approval, respect the leverage. Done right, portfolio margin expands your playbook. Done wrong, it can end your trading career fast. Thanks for joining us. If you found this breakdown useful, hit like, subscribe for more advanced options insights, and drop a comment. Would you apply for portfolio margin or stick with Reg-T?